Hello friends and welcome to StudyIQ. I am Joycey Joy and today in this lecture we will discuss about RBI policies or the central bank's policies in order to avoid an economic slowdown in the country. Now coming to the current affair, we will see that worldwide the central banks, example the US Central Bank, the Federal Reserve, the European Central Bank, the Chinese Central Bank, almost all the major central banks of the global world are reversing or redirecting their monetary policies towards an expansionary monetary policy. So in the recent years, we will see that most of the major central banks, including the Federal Reserve of the United States, have adopted a monetary tightening policy by increasing the interest rates. So now we will see there is a shift or redirection of this monetary policy in major central banks as they have adopted liberal monetary policies or expansionary monetary policies. So we will analyze this issue in detail and we will also understand what are the RBI policies in order to avoid an economic slowdown. But before we begin, this is our channel StudyIQ and we are providing pen drive courses for various competitive examinations including SSC bank courses, UPSC optionals, SSC JEE courses, teaching examinations, railway examinations, defense examinations, RBI grade B, NABARD grade A, UGC NET, UPSC Civil Services Examination, CLAT exams for various state PSCs and also for various professional courses. You can visit our website www.studyiq.com for more details or you can call to any of these numbers for more information. Now let us first understand what is the status of US economy. So, US Central Bank is the Federal Reserve. Like we have RBI or the Reserve Bank of India as our central bank in India, US have Federal Reserve as their central bank of the economy. So, in the last few years, the US Federal Reserve has been gradually and consistently increasing the interest rates. So, increase in interest rate means it is a tightening monetary policy. So, when the interest rates are increased, it means that there is lesser money supply in the economy and thereby we can say that it is a contractionary monetary policy or we can say tightening monetary policy. So when the interest rates are high, the money supply in the economy will come down. And as a result of this, there was an economic slowdown. So because of the tightening monetary policy adopted by the Federal Reserve, the economy started growing slowly and this also led to lesser inflation rates. So when money supply is high, there will be more rates of inflation. And when money supply decreases, the inflation rates also will come down. So as a result of tightening or contractionary monetary policy adopted by the US Federal Reserve, the inflation rates came down in USA and also the money supply came down. And this had led to lesser economic growth in the country. Now, how is inflation and growth related? So, when there is higher rates of inflation, it implies that there is higher money supply. With high money supply will come high growth. So, ideally, there should be a moderate rate of inflation. It should not either go up or come down. So, a moderate rate of inflation will ensure that there is moderate rate of growth in the economy. Now, the official target of the US economy was to contain inflation rates within 2%. But what really happened is that when the Federal Reserve adopted a tightening monetary policy, this led to lesser money supply and lesser inflation rates, and the inflation rates in the US economy came down even lesser than the official targets of 2%. And this lesser number of inflation and lesser growth rate in the economy was criticized for the policies adopted by the Federal Reserve or the Central Bank of US economy. And if we look into the job creation numbers, the American economy created nearly 20,000 jobs in February 2019. So this is the slowest growth rate of jobs in USA in this past year. So the number of jobs created or the rate of employment generation also came down. And along with that, the GDP figures also came down. So all this started with tightening monetary policy of the Federal Reserve. The money supply came down. Therefore, economic activities came down. This led to lesser rates of inflation, lesser employment generation and lesser output in terms of GDP. So all these were the consequences of tightening monetary policy adopted by the Federal Reserve. Now in this context, the Federal Reserve Chairman of the US has made statements that there will not be further increase in the interest rates. Now they are going to shift their policy from tightening monetary policy towards liberal monetary policy. So there will be a shift in the US monetary policy stance from tightening to liberal, or we can say from contractionary to expansionary. So when expansionary policy is adopted, the interest rates will go down. This will ensure that the money supply will increase, and therefore there will be a contractionary effect of money supply in the economy. So this is briefly about the situation of US economy. Now coming to the global picture, let us see what is happening elsewhere in the world. The economic conditions in the Europe and also in Asia are deteriorating, and for this reason the countries in Europe and Asia has also started easing their monetary policies. So European and Asian countries also started adopting liberal monetary policies or expansionary monetary policies. And also another factor that influences the monetary policy decisions of Asian economies and European economies is the monetary policy adopted by the Federal Reserve. Now Federal Reserve has also decided that they are not going to increase the interest rates, but rather they are going to bring down the interest rates. Now this has given a boost to other economies in Europe and Asia region to bring down their interest rates and thereby liberalize or adopt an expansionary monetary policy. Now the European central banks, they have announced that the rates in the Europe will be kept low until next year, and they will make available cheap lending facilities. So this is an indication of liberal or expansionary monetary policy. Even the case of China, the People's Bank of China, which is the central bank of the Chinese economy, has promised further monetary stimulus measures to address the fall in growth. So they are also expansionary monetary policy. And in case of India, the Reserve Bank of India or the RBI is the central bank. So RBI has also started to cut the interest rate. In the last MPC meeting, Monetary Policy Committee meeting, we have seen that from calibrated tightening, the stance of the RBI or the Monetary Policy Committee has come down. So now they are trying to liberalize the monetary policy by adopting expansionary measures or by bringing down the interest rates. So all this indicates that the central banks around the world are reversing the direction of their policies. Earlier they had adopted tightening policies or contractionary policies. Now they are reversing the direction of the policies towards liberal monetary policy or contractionary monetary policy. From all this, we understand that there is a coordinated effort from all the central banks, US Central Bank, the European banks, the China Central Bank, Indian Bank, India Central Bank, RBI. So all these major central banks have adopted or reversed their policy stance towards a liberal or contractionary policy. Now in this situation, what needs to be taken care is that when the interest rates are less, it means borrowing becomes very cheap. So this will lead to cheap borrowing, thereby increased money supply in the economy. Now the banks has to be cautious that this does not lead to mounting of NPAs. So NPA is a non-performing asset. When a loan or the principal amount or the interest rate, when a loan, either its principal amount or the interest is overdue for more than 90 days, we call it as NPA or non-performing asset. So in this context, what needs to be taken care is that this liberalized monetary policy or reduction in the interest rate does not account into mounting of NPAs. So this is where the banks have to be cautious about. Mounting of NPAs will have destructive effects in economy. So this needs to be taken care. Now coming to the particular case of India, RBI is the central bank of the economy, and MPC or the Monetary Policy Committee, which has representatives from both the central government as well as from the RBI, takes monetary policy decisions for the economy. Here what needs to be understood is that the MPC in its last meeting has decided that from calibrated tightening, the policy stance will be changed towards a liberalized monetary policy. So calibrated tightening means reducing the money supply by increasing the interest rates. Now, liberalized policy means increasing the money supply by decreasing the interest rates. So, what will be the effect of this on the economy? First of all, the money supply will go up. Secondly, borrowings will become cheaper. And thirdly, increased money supply will increase the rates of inflation in the economy. Remember, a moderate level of inflation is necessary to boost growth in the economy, and it can be within a range of 2 to 4%. Now, in case of India also, the rates of inflation had gone down. That is the reason MPC has adopted a liberal monetary policy stance. And the fourth impact is that when money supply increases or when borrowings become cheap, the production activities in the economy will increase, thereby output of the economy will increase or go up, and this will lead to increase in the GDP or gross domestic product of the economy. So this will help in containing an economic slowdown, and that is why RBI has adopted a liberal stance or expansionary monetary policy. You can find the PDF of this lecture on my Facebook page, and for any queries regarding your preparations, you can get in touch with me on my Facebook page, or you can email me at joycey.studyiq@gmail.com. Thank you.